Hello, everyone. Today on the final bar, I'm talking to John Gagliardi from Fidelity Investments. We'll talk about some of the longer-term charts that he's paying attention to as we try to make sense of these markets. We talked about yesterday being a digestion day, right? You had the big meal, the big distribution, then you need sort of an after-dinner mint sort of time to digest the meal. Seems like we have another meal that started a day again today with the S&P now forcing its way down below 4,000. The Nasdaq composite leading the way down over 3%. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the language of technical analysis, using the technical toolkit to better understand what investors are thinking, or how they are motivated by their emotional reaction or emotional overreaction to market catalysts, and more importantly, or most importantly, how their emotional state is reflected in stock prices. I was taught by my mentors early on in my career as a technical analyst to focus on price because price reflects what investors in aggregate are thinking. Because if there's an overwhelming amount of optimism, if the pessimism outweighs the optimism, all of those combinations of things, the prices will reflect that. The prices tend to be a pretty good gauge of what the market is thinking. So if you look at a day like today, we see that the Nasdaq the S&P chopping around yesterday, the Nasdaq sort of pushing a bit higher yesterday, moving once again to the downside. We are, by any definition that I've ever learned, in a clear distribution phase, in a bear market phase, whatever label you want to do. And I think labels are less important than an analysis of the trend. I'm seeing lower highs and lower lows. But how does this whole little movement relate to the longer term trend? Today, we're going to look at some of the breadth data and how today's and this week's and this month's sell-offs relate to previous pullbacks in market history. We'll get to all of that and more in a little bit. We have a great guest today, John Gagliardi from Fidelity Investments, bringing a couple charts with him. Coming up tomorrow, we have Matt Maley from Miller Tabak and the Maley Report coming to us from Boston next week. Two pretty decent guests for you. Ari Weld, who's the technical analyst at Oppenheimer in New York, and then Mark Chaikin, creator of a number of technical indicators that many of us take for granted, the Chaikin money flow, accumulation, distribution, and much more, joining his show next Wednesday, the 18th. Let's continue on today's show, talk about this market environment in our market recap. Let's focus on the evidence today and how the short-term movements of today relates to the long-term trends that have evolved over time. When I'm looking at the two-day chart of the S&P 500, you can see sort of that digestion yesterday, the choppiness, sort of a net sideways move, closing right around 4,000. And, in this sort of environment, as the indexes are pushing lower, everyone looking for some scrap of optimism, right? Some indication that things may be bottoming out. And I'll tell you, days like today, while it reminds me that there are plenty of stocks still working, so two, maybe three of the S&P sectors finishing in the green, energy by far the best performer, followed by utilities. At the end of the day, the mega cap weighting, the largest stocks, the mega cap FANG trade types of names are really pushing the market to the downside. The S&P finishing down 1.7%, closing around 39.35. The Nasdaq Composite, Nasdaq 100, both down over 3% today, which is just, again, putting an exclamation point on this continued risk-off environment that we've been seeing. Mid caps and small caps, all about the same. There's no real cap tier, argument, I think, to be made today. Overall, sort of everything was down when you look at the major averages. The VIX, in an interesting move, actually off a little bit, even though the major averages were down. It's a reminder, over time, in general, it tends to be an inverse relationship between stocks and volatility, meaning When the S&P sort of goes lower, you'll often see volatility spike higher. When the S&P is in a nice uptrend, you see volatility decrease, but that's not by definition. Today you have a down day with a little less volatility than we've seen recently. Now, keep in mind, it's still well above 30, which is sort of the proxy for a volatile environment. So we are still there. It's not in our rearview mirror as far as the evidence is telling us yet. Interest rates coming off a bit on the longer end with the 30-year and the 10-year yields both coming down. 10-year yield around 292 here at the end of the day. The 30-year yield still above 3%. The dollar index a little bit above zero. It's using the UUP, which is a bullish dollar ETF. Gold and silver both higher, and really the 8 major energy or commodity ETFs that we track all in the green today, with the DBC up 2.5%. That's a broad commodity index. Oil price is higher, and that's what's helping. One of the things helping the energy sector be the top performer today. If you like the color red, you will appreciate the 10 most liquid coins that we track on Fidelity. You can, or on StockCharts.com, you can see that Bitcoin, Ethereum prices both rolling down to the downside. Bitcoin down about 5%, Ether down almost 10%. We're going to look at the chart of Ethereum a little later. I feel like just the last couple of days, we were talking about Ethereum at 3,000. It was maybe a couple of weeks ago, but how quickly we've now lost a third of the value. It's down almost to the 2,000 level. Big round numbers tend to be pretty meaningful, and you'll see on the chart of Bitcoin how we bounced off of that 30,000 level, now rotating again, testing that level of support, trading below there in the last couple hours. Let's look at a chart of the S&P 500 and see how this recent movement fits into the big picture. Now, we've talked about some of these key support levels as the market has rolled over. And again, a lot of the indications we would use really show the market topping in November, although the S&P made a new high into the beginning of this year. A lot of indexes, some of the other cap tiers, a lot of the breadth data, even the momentum indicators all peaked out in November. And November, December, January was when you start to see those indications that we were in that last move higher. And that indeed is how the trend has played out. Last 4 months have been fairly distributive, with May once again making a new low for the trend here. 4,000 represents a 50% retracement of September 2020 to January 2022. We have tested that level, and arguably with the distribution we see today, you could say that level has failed. And I think that opens the way to further support to the downside. I might start backing up this chart a little bit more, because if we bring in a little more data, we can see the 61.8% retracement level, which is just above 3,800. Now, what's interesting about that is that also lines up almost identically with a 38.2% retracement of the long-term low, the March 2020 low. That's after that big sell-off, February, March 2020. Take that starting point, take the ending point as the high at the beginning of this year, first week of the year. 38.2% retracing the way down gets you right above 3,800 as well. This is why, for me and a number of my peers in the industry, all talking about that 3,800 level. It's a pretty clear level of support if you look at the long-term trend. What's encouraging to me is if and when the S&P would get to 3,800, I think it would be very reasonable to expect at the very least a meaningful bounce, because so many people are anticipating support. A lot of people will be looking opportunistically at that level. That would represent, I think, about a 20% sell-off in the S&P. Reasonable place to expect support. That's the good news. The bad news is, what if that level doesn't hold? Because I'm not looking at a lot of levels below there. We're talking about 3,200 and doing much deeper retracements. And I think if you get to that point where we have to start saying, all right, what's next? That's when you have a waterfall decline where support levels just evaporate. That's when things can really get exciting from a downtrend perspective. What's interesting though is in this environment, as we're thinking about the S&P testing key support, we're thinking about where we're going to find a potential bottom here. There are charts that are working, right? If you look at the chart of the energy sector, it's not bad. You would not know that the cover's coming off here, that things are completely deteriorating underneath the hood. Energy sector, not too bad. Utilities are actually holding up okay. I'm finding stocks making new swing highs in the utility sector. In the utility sector, in terms of a relative performance, improving actually in this environment. So, when it feels like everything is going down, you have to remember it's not just a stock market. When you own just a passive index, you are tying yourself into the performance of the broad indexes. If you have the opportunity to leg into things like energy and utilities and consumer staples, where you're actually seeing some decent charts, this is one of those opportunities where hopefully an active perspective, active management and thinking about where you can rotate on a tactical basis can be really, really valuable and really help you to survive this sort of environment better than others. So again, looking at the 11 sectors, we have the energy sector up the most today, up 1.4%, only a couple others in the green at all. You had utilities up about 0.75%, materials essentially flat for the day. Real estate was number 4. On the downside, it's the FANG and FANG-like sectors. We have consumer discretionary, technology, communication services, all down. Those first two are down over 3%. So certainly quite an interesting move. You know, when you look at our predefined alerts, I often have this, or I usually have this on my dashboard. I rarely refer to it on the show, but I refer to it often during the trading day. Worth noting, the bullish percent index on the technology sector is below 20%. This is a discussion I had with Larry Berman yesterday, right? The argument for buying technology here can't be a technical argument, I would argue, because there's not a lot to like on those charts. Those charts are deteriorating. And as a trend follower, I would much rather look for things that are showing signs of accumulation. But if you're buying some of these names that have been in consistent downtrends, and let's look at the XLK here to finish up our market recap. If you're looking for things that are breaking support and you're looking for things that downtrend, you look for oversold conditions. You look for, you know, when have they gone down so far that investors looking at valuations will see great companies, if that's what you consider some of the big technology companies, which I would argue that's probably a fair description. Great companies at a discount at some point become kind of compelling, and that's why bottoms happen. That's why markets eventually find a floor, because all the selling has pretty much been done, and enough value investors recognize their opportunity to get in on good companies that have been beaten down quite a bit. That's not a sign I'm seeing yet, but that's the argument I'm looking at some of these charts, is looking for signs of stabilization and looking for oversold conditions and recognizing that buyers are coming in. Not today, but we'll keep our eyes peeled for that sort of movement. We need to take a quick break. We'll be back with today's guest, John Gagliardi. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the technical analysis toolkit to better understand investor behavior and market dynamics. We have a great guest today, John Gagliardi. We're going to bring him on here in a few moments. First off, as a reminder, we welcome your questions. We're going to do another mailbag segment at the end of this week on Friday's show. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We have great, knowledgeable expert opinion and commentary and perspective from people like John Gagliardi, Larry Williams, Mark Chaikin, Tony Dwyer, some exceptionally experienced and strong analysts helping us make sense of this market when you're running into trouble. You can see all of their insights for free at StockChartsTV.com, or on your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, John Gagliardi, joining us on the show once again. John's a vice president and technical analysis expert at Fidelity Investments, coming to us from the Northeast. John, it's great to see you, and thanks for coming back on the show.
Thanks for having me. This is great stuff.
So it is a fact. I've often said this sort of environment, it's fun to be a technical analyst or someone using the tool, because this is where I feel like we have the opportunity to add a lot of value. You know, it's a challenging environment, though, and I think a lot of people are seeing their portfolios and certainly the markets deteriorate. We're starting with a longer-term chart of the industrial sector. What is this telling you about the conditions here?
So this was great because you were able to put the box exactly where we left it. The last time I was on the show, it was February 25th, and we drew that exact box. And I said, look, industrials is the core of the economy. And if the economy is doing good and the Fed isn't cutting rates and it's not going to lead us to a recession, well, this box will break out to new highs and we'll have an uptrend. And for a little while there, it made it halfway, or maybe even 3/4 of the way. And then things didn't work out and we broke down. So this is now a downtrend. And what do you do in a downtrend? You sell the rips. And if you say, well, hey, Dave, John, how was I supposed to know that could happen? Well, take a look down there at relative strength. Look at MACD. These things were not exactly pointing up while all this was going on. This was really saying, hey, guys, this is getting weaker and weaker over time. There's more seller, or I like to say, there's stronger sellers than there are buyers, and the sellers are starting to dominate. And sure enough, we had that last hurrah, that last rally to 105, and here we are now at 91. Now, where's the bottom? I don't know. The thing that I always like to say as technicians, we can't predict the future, but knowing where you are, knowing the present is pretty good.
I love that. And you're absolutely right. I think a lot of times when I'm talking to people about technical analysis, it's more about a market awareness, more about understanding where we're at. And that's where I think a lot of people can improve. This is such a great illustration, John, that you gave us about just a transition from an uptrend to just a consolidation phase, and now arguably a clear rotation to the downside. Now, your second chart is a great long-term chart. This is a monthly chart of the S&P. Going back to a secular bear market in the 1970s, talk us through this one.
I always talk about this, the 1970 to 1982, you're looking at the generation called the lost generation. We never talk about these people. Their market went nowhere for 19 years. 1982 to 2000, you get the baby boomers. Market rips for 19 years, 1,550%. Then from 2000, 2013, we go nowhere yet again. Generation X, thank you very much, that's me. And of course, 2013 to present, we have the millennials. Fantastic bull market. But what the heck is this stuff on the right? A lot of this was driven by the Fed. And as we know, the Fed giveth, and now the Fed taketh away. And as this is happening, we're coming down. Now, there's a line to be noted that I only hear a couple of people talking about this, which makes me think it might actually work. It's that uptrend line. And we're not looking at the support line, we're looking at the resistance. This line acted as resistance, not a year or two, but this acted as resistance for more than a decade. And one thing we know about technical analysis, what used to be resistance will probably act as support on the way down. And we are on the way down. So if it happens immediately, we're looking at 3,800. Sounds a lot like something I just heard. And also to be noted, the folks at Fidelity, Urian Timmer is saying 3,800. The exact number, by the way, is 3,813 if you want to be exact. That would be your retracement, a big giant retracement off of the COVID lows. And if you think about it, it kind of makes sense because COVID was an emotionally driven sell-off. And what we just saw in the last year was an emotionally and liquidity driven rally in the market. And now that we're pulling back, let's see if this new expansion of the S&P holds. And if not, hey, long term, the market goes to 3,200. Long term, it's still going up. It's still an uptrend. You just have to hold the COVID lows. That's all you got to hold.
That's exactly right. John, people have asked me why I tend to have more of a focus on risk management and more of a bearish feel to my analysis. Right here in the middle of your chart in 2000 is when I started investing. That was my first job. That was my 401k. You can see the exciting experience I had as an investor in my formative years. I saw that everything that was going up all of a sudden stopped the moment I started putting money to work. So I think you've made it pretty clear. So we only have about 30 seconds left, John. But when you're looking at this market right now, where are you? What would you be looking for a sign of life? What would tell you that it's time to get back to risk on? Is it something like we reached 3,800? Is there some sort of indicators and improvement in things like the oscillators that you mentioned earlier? What would you be looking for here for optimism?
I've got the world's best indicator. It's called July. By July, the Fed will have increased rates at least 100 basis points. And if you look around and you're starting to see uptrends starting to creep back in, then by all means, that July is the indicator. Forget about everything else we know, because one thing we know of, like I always say, don't trade on hope, think, or feel. What do you know? I know for a fact the Fed is raising rates in June. I know for a fact he's probably going to do it again in July. So check out the July date, and when the Fed hits the hammer again, if stocks are starting to go up, you know that the worst might be behind us. And then you could start looking around. By the way, you want to throw up a great chart? Put in Hershey, HSY. Put in Campbell's Soup. Put in, I mean, the things that, like, you would still be able to have in Armageddon, right? This thing, it's an uptrend. Hershey. Do I have the right symbol? Yeah, Hershey Foods. I think there's more to the right of the chart, unless we sold off a little bit. But stuff that's doing well is the stuff that you would stock up on if it was Armageddon, right? Hershey chocolate never goes bad. Lasts you 20 years. Buy some Twinkies. Get them Campbell's Soup, right? Those are the things that are holding up. Kroger Foods, KR.
Yeah.
These guys can figure out how to pass on all of that, all of those things like inflation onto their customers immediately. It's not sexy tech, but it's tech of supermarkets. Who's got the best supermarket? Who can pass on costs immediately? Hershey. These guys have been at it 100 years. They know how to pull back production. They know how to run a business. That's what's doing well.
Decent case for consumer staples there, John. We have to move on, but listen, thanks for coming by. Stay safe there, and we'll talk to you again soon, all right?
Thank you, Dave.
That's John Gagliardi. John's a vice president at Fidelity Investments and the resident technical analysis expert that I enjoy talking to. I'm actually going to be working with John on a panel for Fidelity coming up soon on Thursday, May 26th. It's called Charting Your Opportunity. We're going to do a panel. I know John's going to be sharing some technical education as well. You can go to fidelityevents.com/chartingyouropportunity. And we'll both hope to see you there for sure. I love that quote, by the way, that John shared with us. Don't trade on hope, think, and feel. I wrote that down as he was saying that. I might revisit that one and give John full credit. That was well done. Thanks, John Gagliardi, for joining us here. We need to move on to the next segment called Banking on Breadth. So what we like to do with some regularity is focus on the breadth conditions. And I will give you a brief preview. It doesn't look good for the market here. We are in challenging environments. And again, the main thing I think you can do in this sort of environment is focus on price. Let the price tell you what the conditions are. Let them tell you when things are improving or not. The price will reflect what the sentiment is of the underlying investors. But breadth tells you a little more detail, sort of looking underneath the hood at some of the major indexes. We know the S&P is going lower. We're notice the Nasdaq's going lower. What about the breadth indicators? What about the stocks that comprise those major indexes? We'll start with the chart we refer to pretty regularly. This is part of our Mindful Investor live chart list, which you can access on StockCharts at any time. We're looking at a closing price of the S&P over the last year at the top. And then we have breadth for the New York Stock Exchange for large caps, for mid caps, and for small caps. 3 of these 4 are very subjectively color-coded red by myself because they have made a new low for the year in the last week. Right, the New York Stock Exchange, pretty broad universe of U.S. stocks, the mid-cap breadth, the small-cap breadth, all in a confirmed downtrend. The only one that is not broken down yet is the S&P 500, the large-cap breadth. Now, why is that the case? Well, look at some of the mega-cap names that you would think about. Look at Microsoft. Look at Apple. These are, out of all the stocks that are in downtrends, these are some of the ones that are holding up some of their gains and not quite breaking down. The problem is the more and more of those happen, the more the breadth deteriorates. And usually at a market top, you'll see the breadth conditions deteriorate in the other cap tiers. The large cap breadth is usually the last one to rotate lower because people can get defensive. You can hide out in an Apple or a Microsoft and try to ride things out. But eventually you take your bets off the table altogether. You pull it out of equities, and that's where the breadth can start to rotate lower. So from a risk perspective, this is very much a risk-off configuration. When these are making new highs, that tells you the conditions aren't bad. Going into January, you saw 2 of the 4 made a lower high, while the other 2 made a higher high. That was an early warning that things were going to start to get ugly, and you can see, indeed, they've continued to go lower. So this might be an interesting chart to watch. When do we get that confirmation that the S&P breadth is making a new low as well? We'll jump around through some of these charts here. I just want to point out the percent of stocks closing higher or lower. We often refer to advanced decline data, and there's no real standard way in the industry. I've talked with, having been in a number of firms and talked with a number of my peers in the industry, there's just no standard way to think about breadth. So here's how I do it. I look at the percent of the New York Stock Exchange listings that are closing higher on the day and the percent that are closing lower. It is super straightforward and super clean, and that's helped me understand the overall environment. If you look, over the last week, the red bars have been much higher than the green bars, to put it very simply. Those are the stocks closing down on the day in red. In green, we have the stocks closing up on the day. You can see a handful of names where we had almost a 90% down day, meaning 9 stocks out of 10 on the New York Stock Exchange were closing down on a particular day. That might sound like capitulation to you, thinking, oh man, if 9 out of 10 are going down, that might be the end. Here's the problem. In a deeper downtrend, like think about 2018, 2019, you'll have a cluster of those days as everyone starts selling everything. That's sort of environment that I think we're seeing here. You need that to start to change. You need up days that start to build momentum where buyers are coming in, value investors, and finding the opportunities that we're not necessarily seeing in the price just yet. We're going to spend a few moments on this chart here. This is the percent of stocks on the S&P 500 trading above their 200-day moving average and the percent trading above their 50-day moving average. This updates every day, a little after the close, not quite updated for today's close. So these will most likely both go a little bit lower, given the fact that we had the sell-off during the course of the day today. But as of yesterday's close, 30% of the S&P members remaining above their 200-day. That, of course, means 70% below their 200-day. Only 18% of the S&P members are above their 50-day moving average as of yesterday's close. That's not even what today's sell-off included. So again, at a first glance, wow, this is the lowest it's been for the last 2 years. Is that the sign of a bottom? Here's the problem. We bring in way more data. This is going back about 15 years. So it's a lot of data. So don't worry too much about that. But look at this bottom series in green. Here's where we're at right now, right? 18% of the S&P above their 50-day moving average. Here's what happened in first quarter of 2020. We got down to 0%. Here at the end of 2018, we got down to 0%. When the market actually bottoms out, everything's gone down. Everything's broken down. Nothing is left holding up. At the other major bottoms here in 2011, here in 2010, we got to about 5%. In 2008, we got down to 0% and spent about a couple months down there with pretty much everything down. So almost all of the S&P was below its 50-day and all below its 200-day. That is what a longer deterioration can look like. So when I think about the S&P down, 10, 15%, I'm looking at these breadth numbers. While they seem low relative to the standards of the last 2 years, they're nowhere near the bombed out breadth considerations that can happen when the market really starts to deteriorate further. That's the worry I have about this current market. If you're thinking of it as another buy on the dip opportunity, that could absolutely work, but I'm not seeing that sort of evidence of capitulation that you may see at previous bottoms in bear markets. We need to wrap this show, folks, and go to the 3 in 3. Let's review 3 charts in 3 minutes to tell the story of this market environment. Here is chart number 1. It's kind of laughable to bring up Dow theory in this sort of environment because it is no real surprise what's happening. But, in this environment, when everything's starting to roll over, my question for John Gagliardi and others, like, what would you look for that would tell you conditions are improving? Larry Berman yesterday was talking about valuations and looking for some bounces in key areas of the market, some of the seasonal trends as well. John Gagliardi today saying basically wait for the Fed to finish its process because that's what's really, probably impacting the market to the downside currently. I would look at a chart like this. This is what I call the new Dow theory, the S&P 500 on a closing basis on the top, the Nasdaq composite on a closing basis on the bottom. Both of these have undercut their March low with vigor, and that tells me that we're in a distribution pattern. You need this to start not confirming, right? A confirmation is what you've seen now with both of them breaking down. When does one of them make a new low and the other one does not? That would be a reason to pay attention to this chart. Right now, it's confirming a downtrend environment. Chart number 2 in our segment, Banking on Breadth. We looked at some of the breadth data out there. And again, we didn't have time to get to all of it, but my quick summary is the breadth data is bearish and not improving yet. And I have to remind you that even though it feels like 30% of the S&P above their 20-day isn't that low, or 200-day isn't that low enough, 18% of the S&P above their 50-day isn't that low enough, the answer is not necessarily, right? And if you look at deeper sell-offs in terms of time and or price, these indicators have gone way lower. In fact, both of them have gone down to 0 a number of times in the last 15, 20 years. That's what bear markets actually feel like. We might not be anywhere near done if you look at that and think about some of the historical trends. Finally, cryptocurrencies, very ugly today. A lot of red on our crypto page. You can go to StockCharts.com/crypto to see we have over 100 coins that we track, and you can run technical indicators on. The chart of Ethereum has certainly deteriorated very, very quickly. Bitcoin and Ether were both making new swing highs March into April. It started to be a little bit encouraging. Ether failed to eclipse its 200-day moving average, stalled as it attempted to close above there, rotated back to the downside. Now we are testing, or getting very, very close to testing 2,000. We've now undercut the lows for 2022, making a new low. We're testing that 2,000 level, which is a big round number, but the real support is all the way down here, just above 1,700, around 1,715. Those are the lows from mid-2021. That may be a reasonable downside objective given the sell-off that we've seen in cryptocurrencies. Folks, that's our show for today. Special thank you to John Gagliardi joining us from Fidelity Investments in New Jersey and sharing his thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.